Welcome to the Skilled MBA Human Resource Management Case Study Series. At Skilled MBA, we analyze how central banks in emerging economies navigate the delicate balance between price stability and economic development. Today's case focuses on the South African Reserve Bank, SARB, which, in the post-apartheid era, faces the challenge of managing inflation targeting while supporting inclusive growth. Key insights from this case: understanding SARB's core mandate, maintaining price stability through inflation control, managing tensions between tight monetary policy and the need for pro-growth interventions, navigating external shocks, capital flow volatility, and structural inequality in a complex economic landscape, exploring how communication, credibility, and transparency influence investor confidence and economic resilience. This case highlights how central banks in emerging markets must be technically sound yet contextually sensitive, balancing macroeconomic goals with social realities. Explore the mechanics of inflation targeting in emerging markets, focusing on implementation challenges. Analyze policy trade-offs between price stability, employment, and growth in developing economies. Assess how central bank decisions impact market expectations and institutional trust. Formulate evidence-based strategies for macroeconomic management during economic distress. By December 2001, South Africa grappled with inflation nearing 8%, surpassing the 3 to 6% target. Economic growth stalled, industrial output declined, and the rand depreciated significantly. Unemployment hovered around 30%, a remnant of apartheid. Consumer and business confidence weakened, and the nation faced high vulnerability to volatile global capital flows. In February 2000, South Africa adopted the inflation targeting framework, aiming to keep inflation between 3 to 6% through interest rate adjustments. This policy sought to establish credibility, anchor inflation expectations, and ensure macroeconomic stability. By December 2001, the framework faced challenges as inflation exceeded targets amid faltering economic growth. The South African Reserve Bank faced a dilemma. Should it raise interest rates to control inflation, risking economic contraction, or lower them to boost growth and employment, risking higher inflation and capital outflows? This balancing act highlights the complexities of maintaining economic stability while addressing growth and employment challenges. South Africa's inflation targeting (IT) framework focuses on a 3 to 6% inflation target, prioritizing price stability. It uses interest rates as the main tool, with transparent communication and forward-looking forecasts. Challenges include limited fiscal support, supply-side inflation, high exchange rate pass-through, structural unemployment, and political pressure for development-focused policies, questioning its developmental suitability. Analyzing strategic options, we consider three paths: maintaining strict inflation targeting, temporarily allowing inflation to exceed targets, or redesigning the framework to include flexibility. Each option has distinct advantages and drawbacks, from building credibility and stabilizing expectations to risking recession or requiring complex implementation. Balancing these factors is crucial for aligning with South Africa's economic realities. Strict inflation targeting ensures price stability, fostering sustainable growth and enhancing central bank credibility. Clear targets reduce investor uncertainty, as seen in New Zealand and Canada. However, developing economies face unique challenges. High unemployment and supply-side inflation demand flexible policies. Rigid frameworks risk amplifying economic cycles, necessitating tailored approaches for development objectives. Emerging markets face unique challenges like capital flow volatility, complicating monetary policy. Exchange rate sensitivity impacts inflation through import prices, creating a balancing act for central banks. Structural unemployment, as seen in South Africa, reflects historical legacies. Development imperatives in infrastructure and social services often conflict with strict monetary discipline, questioning the suitability of developed economy frameworks. Inflation targeting, IT, has reduced inflation in developing economies, yet its impact on growth and stability during external shocks varies. Countries adopting flexible inflation targeting frameworks often manage crises better, balancing inflation control with economic resilience. This approach highlights the need for adaptable monetary policies tailored to specific economic contexts. Monetary policy in post-apartheid South Africa was deeply intertwined with social challenges. Economic decisions significantly impacted inequality, poverty reduction, and social cohesion. As the nation healed from historical divisions, these policies were crucial in shaping a more equitable society, highlighting the need for a balance between technical economic goals and social imperatives. Central bank independence ensures policy credibility and price stability, yet it raises concerns about democratic accountability. In South Africa, the South African Reserve Bank faced scrutiny over whether unelected officials should influence policies with significant societal impacts. Balancing inflation control with broader development goals remains a challenge in emerging markets, highlighting the governance dilemma in monetary policy. The South African Reserve Bank governor faced complex decisions. Policy changes risked the South African Reserve Bank's market credibility, while global financial constraints limited flexibility. Economic impacts on growth, employment, and investment were crucial. Stakeholder responses from business, labor, and government varied. Short and long-term implications required careful consideration to guide South Africa's economic path. Monetary policy must align with a country's unique context, acknowledging that trade-offs are inevitable. Central banks face the challenge of balancing credibility with flexibility, especially during crises. Effective policy extends beyond technical analysis, requiring insights into political economy, social context, and institutional constraints to navigate complex economic landscapes. Thank you for exploring this central banking and emerging market strategy case with Skilled MBA. We hope the South African Reserve Bank's experience provided deep insight into the challenges of responsible monetary policy in a dynamic development context. For more case studies on macroeconomic policy, financial governance, and institutional leadership, connect with us. Mobile, +91 8755 Email, support@skilledmba.com. Website, https://skilledmba.com.